Cryptocurrency exchanges have witnessed explosive growth in recent years, with digital assets becoming increasingly mainstream. However, this rapid rise has brought regulatory challenges, particularly in the areas of anti-money laundering (AML) and countering the financing of terrorism (CFT). But what exactly is a cryptocurrency exchange? And how are AMLCFT regulations impacting it? In today's video, we'll be taking a look at what is a cryptocurrency exchange, how AML-CFT regulations are impacting them, and examples of cryptocurrency scandals. Hello, and welcome to another KYC Lookup video where we bring you AML-related content to help you enhance your knowledge in the fight against money laundering. Before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. So, on to today's video. What is a cryptocurrency exchange? A cryptocurrency exchange is an online platform or marketplace that facilitates the buying, selling, and trading of cryptocurrencies. It serves as a digital marketplace where individuals and institutions can exchange one cryptocurrency for another or convert cryptocurrencies into traditional fiat currencies like the US dollar, euro, or yen. Some key features and functions of cryptocurrencies exchanges include trading pairs. Cryptocurrency exchange offers various trading pairs, which specify the cryptocurrency that can be traded against each other. For example, a common trading pair is Bitcoin, BTC, and Ethereum, ETH, which allows users to exchange one for the other. Order book. Exchanges typically display an order book that lists all the current buy and sell orders for various cryptocurrencies. Traders can place market orders, buy or sell at the current market price, or limit orders, buy or sell at a specific price. Wallets. Most exchanges provide users with digital wallets to store their cryptocurrencies securely. These wallets may be hosted by the exchange or, in some cases, provided by users themselves. User accounts. Users need to create accounts on cryptocurrency exchanges to access their services. These accounts often acquire identity verification, especially on exchanges that comply with the Know Your Customer (KYC) and anti-money laundering (AML) regulations. And liquidity. Liquidity is a measure of how easy an asset can be bought or sold without significantly affecting its price. Well-established exchanges typically have high liquidity, making it easier for users to execute large trades without significant price fluctuations. Cryptocurrency exchanges play a central role in the cryptocurrency ecosystem by providing a platform for users to access digital assets and participate in the global crypto economy. But users should exercise caution when choosing an exchange and consider factors such as security, fees, available features, and regulatory compliance when making their selection. How are AML-CFT regulations impacting cryptocurrency exchanges? Cryptocurrency, once perceived as the Wild West of finance, has come under increasing scrutiny from regulations worldwide. This scrutiny is primarily driven by concerns related to money laundering and terrorist financing. To combat these risks, anti-money laundering (AML) and countering the financing of terrorism (CFT) regulations have been introduced, affecting cryptocurrency exchanges profoundly. Here are some of them. Enhanced identity verification. AML-CFT regulations have mandated cryptocurrency exchanges to implement stringent Know Your Customer (KYC) procedures. These procedures require users to provide detailed identification and financial information before they can engage in trading. This measure enhances transparency and makes it more challenging for individuals to conduct transactions anonymously on exchanges. Transaction monitoring and reporting. Cryptocurrency exchanges are now obligated to implement robust transaction monitoring systems to detect and report suspicious activities. They are required to keep records of transactions, especially large or unusual ones, and report any suspicious transactions to relevant authorities. This proactive stance helps authorities identify and prevent potential money laundering or terrorist financing activities. International compliance standards. As cryptocurrencies operate on a global scale, exchanges often need to adhere to international AML-CFT standards. Many countries are adopting recommendations set forth by organisations like the Financial Action Task Force, FATF. This means that exchanges need to comply not only with their local regulations, but also align with global standards, creating a more uniform regulatory environment. Impact on privacy and anonymity. While AML-CFT regulations are crucial for preventing illegal activities, they also raise concerns about individual privacy. The need for extensive personal information and transaction monitoring can erode privacy, sparking debates about the balance between security and individual rights. Some cryptocurrency advocates argue that privacy-focused cryptocurrencies like Monero and Zcash are gaining popularity as a response to these concerns. Geographical impact. The impact of AML-CFT regulations varies from country to country. Some nations have embraced cryptocurrencies and established more relaxed regulations, while others have imposed strict controls. This has led to geographical discrepancies in the cryptocurrency exchange landscape, with certain exchanges choosing to restrict or exclude users from specific regions to comply with local regulations. Compliance costs. Complying with AML-CFT regulations is a resource-intensive endeavour for cryptocurrency exchanges. Developing and maintaining KYC processes, transaction monitoring systems, and reporting mechanisms require significant financial investments. For smaller exchanges, these compliance costs can be a barrier to entry and may limit competition in the market. User experience and trust. On a positive note, AML-CFT regulations have enhanced the overall user experience on cryptocurrency exchanges. Users can now have greater confidence that exchanges are taking measures to protect their funds and prevent illicit activities. This, in turn, can contribute to greater trust in the cryptocurrency ecosystem, attracting a broader user base, including institutional investors. AML-CFT regulations have ushered in a new era of accountability and transparency in the cryptocurrency industry. While they are essential for mitigating risks associated with money laundering and terrorist financing, these regulations have also raised concerns about privacy and increased the cost of doing business for cryptocurrency exchanges. Striking a balance between regulatory oversight and the core principles of cryptocurrency, such as decentralization and privacy, remains a challenge. Nonetheless, the cryptocurrency industry continues to evolve, adapt, and work alongside regulators to address these concerns while maintaining its innovative spirit. Examples of cryptocurrency scandals. There have been several cryptocurrency scandals throughout the history of cryptocurrencies. These scandals often involve fraud, theft, regulatory violations, or other illicit activities related to cryptocurrencies. Some notable cryptocurrency scandals include Mt. Gox collapse, 2014. Mt. Gox was one of the earliest and most prominent cryptocurrency exchanges. In 2014, it filed for bankruptcy after claiming that it had lost approximately 850,000 bitcoins, worth over $450 million at the time, due to hacking. The incident had a significant impact on the cryptocurrency market and led to increased scrutiny of exchanges. Bitfinex hack 2016. Bitfinex, a major cryptocurrency exchange, suffered a security breach in which approximately 120,000 bitcoins were stolen, worth around $72 million at the time. Bitfinex issued BFX tokens to compensate affected users, eventually redeeming them. Quadriga CX scandal 2019. Quadriga CX, a Canadian cryptocurrency exchange, faced controversy when its founder and CEO, Gerald Cotton, passed away, taking the passwords to cold wallets containing customers' funds with him. This resulted in the loss of approximately $190 million in cryptocurrencies. OneCoin Ponzi Scheme 2017. OneCoin was a fraudulent cryptocurrency project that promised massive returns to investors but had no blockchain or real value. It was later revealed to be a Ponzi scheme, and its founders were charged with various crimes. The scheme defrauded investors out of billions of dollars. Plus Token Scam 2019. Plus Token, an Asia-based cryptocurrency wallet and investment platform, turned out to be one of the largest Ponzi schemes in the cryptocurrency space. It attracted millions of investors and scammed them out of an estimated $2 billion. BitConnect Ponzi Scheme 2018. BitConnect was a cryptocurrency lending and exchange platform that promised guaranteed returns to investors. It was ultimately revealed to be a Ponzi scheme, resulting in legal action against its promoters. And exit scams. Various smaller cryptocurrency projects and exchanges have conducted exit scams, where the operators shut down the platform and disappears with users' funds. These scams have affected users in various ways, causing financial losses. These scandals underscore the importance of due diligence and caution when dealing with cryptocurrencies. Users should be wary of projects and platforms promising unrealistically high returns, and they should conduct thorough research before investing or trading in the cryptocurrency space. Additionally, regulatory authorities have increased their efforts to combat fraud and enforce compliance in the cryptocurrency industry, aiming to protect investors and maintain market integrity. Well, there you have it. What is a cryptocurrency exchange? How AMLCFT regulations are impacting cryptocurrency exchanges, and examples of cryptocurrency scandals. Please let us know in the comments section if you think more needs to be done to regulate cryptocurrency exchanges, and any other topics you would like us to cover in the future. We have now launched our very own courses for you to take a more in-depth look at a variety of subjects, such as Introduction to AML, Beneficial Ownership, and Customer Risk Rating, for example. So make sure you visit our website for further details, and let us help you connect the dots in KYC. Thank you for watching the video, and if you made it this far, don't forget to like and subscribe to watch more amazing videos.